So the 2025 A-Level Part 1 paper, question number 1. What is the correct sequence of the following steps that are occurred in the financial accounting process of the firm? Okay. So first of all, you will record transactions and prepare a source document as a proof of the transaction. Then that source document, okay, um, through the source document, you will record the transactions to the prime entry book according to the order of the date. After that, the balances of the prime entry book, the total of the prime entry book will be taken to the general ledger, so ledger account. That's the third one. And then you will balance off that ledger account and post it to the trial balance. So the answer is B, A, D, and C, answer number 4. Answer number 4. Then, second and third. Which of the following accounting concepts is or are considered in deciding the correct treatment for above A and E in the books of Aurelia Enterprise? Okay, this is Aurelia's business. They have given a few transactions. The owner of the firm provided a land worth 500,000 as additional capital. Owner's investment is based on entity concept, right? Then E. The computer worth 300,000, which was personally owned by the owner, has been stolen while it was at the business premises. Owner's personal computer being stolen is not a part of business transaction. It's a personal loss. Okay, so that is also based on business entity concept. So the only concept that connects A and E, okay, or only concepts that are relevant for A and E is the business entity concept. Therefore, that's answer number 1. Third one, for which of the following above transactions matching concept is applied in preparing financial statement? For the first one, matching concept is not applied. Okay, so matching concept is applied when there is a expense. The firm purchased a processing machine costing 240,000 on 1st of August for cash and commence using from this date. It is depreciated over a period of 24 months. So depreciation is based on matching concept. So B will affect the matching concept. C. The firm paid 180,000 to creditor after receiving a 10% discount. So receiving a discount is not matching concept, that's realization concept. Income, the main concept is realization. Expenses, the main concept is matching. Then D. The firm paid the monthly loan installment of 60,000, including an interest of 15. So interest is it's connected to matching concept because it's an expense. So B and D, that's answer number 3. Answer number 3. Fourth one, which of the following accounting equation reflect the net impact of all of the above transactions as at 31st of August 2025 in Aurelia Enterprise? Okay. Asset equals to liability plus equity. So, the owner of the firm provided a land worth 500 as additional capital. So asset plus 500 land, equity additional capital plus 500. Okay. The firm purchased the food processing machine costing 240 on cash and commenced using it from this date. Okay. So office equipment plus 240 under asset. Since you're buying it on cash, again under asset minus 240 cash. Next, what is happening? It is depreciated over a period of 24 months. One additional point. You have to start depreciating the asset from the date it was available to use. Okay, available to use. Okay, so from the date 1st of August 2025, it is available to use. In a depreciation for a month, no? 1st of August, they are asking the impact as at 31st of August. So depreciation is provided over 24 months. So 240 divided by 24 months, that is 10,000 depreciation. So asset value will decrease by 10, and since it's an expense, equity will be minus 10 as well. Then The firm paid 180 to a trade creditor after receiving 10% cash discount. So remember, the settled amount will have the cash amount paid and the discount amount. Now here they are saying the cash paid to creditor is 180 and they are giving a discount of 10%. Now discount of 10% is given on the settled amount, right? Therefore settled amount will be 100%. Then the cash amount will be 90%. So if cash amount is 90%, how much is discount amount? 180 divided by 90 into 10, that will be 20,000. Okay, then the settled amount will be 200. Therefore liability, creditor minus 200. Out of that, you are paying cash 180, asset minus 180. The remaining 20 you are getting as a discount, that is the income, therefore equity will be plus 20. Then the firm paid the monthly loan installment of 60,000, including a 15%, 15,000 interest. So the loan installment full amount will loan installment will reduce your cash minus 60. Out of that, your interest expense is 15, equity minus 15. Therefore, the loan amount you're settling out of that is 45,000, liability minus 45. Then the e-transaction is shown as personal transaction. It won't affect your equity or it won't affect any component of your business. Then you can balance this off and find out the answer. Asset 500 minus 10 minus 180 minus 60, that will be 250. Here it's gonna be 100 and wait, minus 245. Here plus 250. And equity 500 minus 10 plus 20 minus 15 plus 945. No, 495. So the answer is the fourth one. The answer is the fourth one. Okay. And then the fifth one. Vimal Traders, a retail business, was commenced on 1st of January 2025 by investing rupees 300,000 cash. What are they asking for? Source document used to record above transaction A, B, C, D respectively. Okay, A. Purchase goods from Sampath Traders on credit. So that is going to be purchase invoice. Purchase invoice. Returned goods purchased from Sampath. Purchase return will be debit note. Debit note. Sold goods. Sold goods costing 600 for 885 on cash. So that is a receipt. Receipt. Paid the full amount due to Sampath in cash after getting a discount. That is payment voucher. Payment voucher. So purchase invoice, debit note, receipt and payment voucher. That is answer number 3. Okay. Then the sixth one. No, wait. Purchase invoice, debit note, debit. Sorry. Then that's gonna be answer number 1. Answer number 1. Answer number 1. Okay. Sixth one, the correct double entry to post the total of the purchase journal of Vimal Traders for the month of January. So purchase journal, we will put only the credit purchases. So credit purchases is only A, right? Only in A, there was a credit purchase. So purchase good from Sampath for 944, including a VAT of 144. Then double entry is simply gonna be purchases debit 800. Okay, because the VAT included in that is 144. No, this is a VAT registered business. Then VAT you should record in the VAT control. VAT control purchase VAT will be debited 144. Then the total amount you will have to pay to your creditor will be 944. Then the answer will be purchases account debit 800. VAT control account debit 144. Creditor control account credit 944, answer number 2. Now, why is the fifth one wrong? Here they are saying VAT expense account. We don't have account called VAT expense or VAT income. We have a VAT control account. All our VAT related transactions are recorded there. Okay. Then the seventh one, net profit for the month and VAT control account balance as at 31st March, for 31st Jan of Vimal Traders. Okay. So here This is the only sales related transaction. Okay. Sold goods costing 600,000 for 885 for cash, including a VAT of 135. And how much will be the sale value? The sale value will be 885 minus the VAT amount 135. The selling price of that would be 750. Okay, then cost of sale, you can directly put the value of the cost of goods of this sale. That is 600,000. The goods are 600,000. Then you can get your gross profit as 750 minus 600. That is 150. 150. Then pay the full amount due to Sampak traders after receiving a cash discount of 30,000. So plus discount received 30,000, you can get your net profit as, there is no any other expense, net profit as 180. Then VAT control account balance. Okay, you have to prepare a VAT control account, and record all the VAT transactions. Okay, now here, firstly, purchase goods from Sampak traders for 944, including 144 VAT. So that's the sales VAT. Sales VAT is a liability. It will come to the credit side. Sales VAT 104. Wait, that was a purchase. Purchase goods. Sorry. Purchase goods are asset because it's a receivable. It will come to the debit side. Purchase VAT. 144. Okay. Then return goods purchased for 177,000 to Sampak, including a VAT of 27,000. So purchase return, okay, now purchase VAT is debited, purchase return VAT will be credited. Purchase return VAT 27. Then sold goods costing 600 for 885, including 135 VAT. So sales VAT will come in the credit side. Sales VAT 135. So there is no any other transaction connected to VAT. You can balance this off. 135 plus 27, that is 162. 162 minus 144, that is the BCD is 18. So if the BCD is 18, here it will come to the next month as BBF 18 in the credit side. Therefore, it is a credit balance. So net profit 180 and the VAT control account having a credit balance of 18. That is answer number 4. Answer number 4. Then, eighth one. Which of the following statements are correct as to the cash transactions of Dimutu traders during the month? The debit balance of the cash account of the business as at 1st of January 2025 was 200,000. Debit balance of the cash account of the business as at 1st of January was 2,000. Then what you have to do? You have to prepare the they are asking for the opening balance of the cash account, right? Then you have to prepare the cash account. Okay, see here. The cash account balance of the business, you can read this and find. The cash account balance of the business as at 1st of January did not agree with the bank statement balance on this date. The reason for the difference was the check of 100,000 deposited in the bank was not realized. Okay, see here. The balance as per the bank statement. Now here this is the bank statement of January. As per the bank statement, there is a balance of 100,000 on the opening date. Okay. But then they are saying here, the balance of the cash account as at the opening date did not agree with the balance at the bank statement in the opening date. because of an unrealized check of 100,000 of the last month. Then the bank unrealized check is a check that we have received, we have deposited, but the bank has not recorded it yet. That means we have recorded it, okay, as a receipt in the debit side of the cash account, but then the bank has not recorded it. That means what would have been the cash account balance? 100 plus we have recorded this 100. We would have a balance of 200,000 in the cash control account opening balance. Sorry, yeah, cash control account opening balance would have been 200,000. Therefore, this is correct. B. The check deposited in the bank but unrealized during the month were 150,000. Okay. As per the bank account of the business, total cash received deposited in the bank and the total cash payments made through checks during the month of January were 950,000 and 700,000 respectively. That means we have totally received checks worth 950 and deposited it. At the same time, we made payments for 700,000 through checks. Okay, what are they saying here? The check deposited but unrealized were 150. How can we figure that out? See here, we deposited checks worth 950,000, but the bank has realized only checks worth 800,000, including a check deposited on 31st December 2024, including the check unrealized of last month. Okay, last month's unrealized check was 100,000. That was also realized during this month. Then how much checks that are deposited this month are realized? 800 minus last month's unrealized check realized this month. Out of the checks deposited this month, only 700 worth of checks were realized. Then what is the unrealized check? Unrealized check will be equal to deposited check minus, what are they asking? Deposited check minus. Now here they are not asking the total unrealized check. They are not asking the total unrealized check. No, yeah, they're asking the total unrealized check. Yeah, sorry. Yeah, they're asking unrealized check. So then we have deposited checks worth 950,000. From that, you have to deduct the check realized for the month. That means the check realized, okay, out of the check that we deposited during the month. Understood? So see here, if you deduct this 100,000 last month's unrealized check from the checks realized this month, because see, last year's unrealized check, the last month's unrealized check will be realized this month. That's what they are saying. So you have to remove that 100 to find out of the check deposited during this month, how much was realized. That is 700. And what is the actual unrealized check amount? 950 minus 700, that is 250. 250. Because of that, the second statement is wrong. Second statement is wrong. The actual unrealized check amount is 250. 3. The check not presented for payment by the end of the month. Unpresented check. So we have issued checks worth 700,000. Out of that, how much have get presented? 600,000. So the unpresented checks are 100,000. The difference is 100,000. That is correct. D. The total cash receipts of the business for the month was 1,075,000. How do you find the total cash receipt? The amount of checks you deposited, 950. Amount of checks you deposited. For that, you have to add the direct remittance. Okay, direct remittance of 125. 950 plus 125, that is 1,075,000. That is the total amount of money we have received during the year. The deposited check, we have got money and put it to our bank. That's the receipt, 950. Apart from that, investment income has been directly put to the bank, 125. Totally during the month, you have received cash worth 1,075,000. Therefore, D is correct. So A, C, and D, answer number 3. They're asking for the correct statement. Be careful. Sometimes they'll ask for incorrect statement as well. Then, ninth one, As at 31st of January 2025, the balance of the cash account before the receipt of the bank statement and the adjusted balance of the cash account after the receipt of the bank statement. Okay. Now, how can you find the adjusted balance of the cash account here? You can find it through the bank reconciliation statement. Okay. We'll prepare the adjusted cash control. Now here they are asking the cash account balance before the receipt of bank statement. So the balance of the cash account before the adjustment. That means they're asking the BBF in the adjusted control account. Okay. Then adjusted balance of cash account you can find through the bank statement. Bank reconciliation statement. Okay. Now here you will have adjusted cash control, plus the unpresented check minus unrealized check. You will get balance as per bank statement. So then, balance as per the bank statement, the closing balance of the bank statement is 360. Unpresented check we found as 100,000. Unrealized check we found as 250. Then what will be the adjusted cash control? 360, you go reverse, plus 250 minus 100, you will get as 510. Then that you will take as the BCD in the adjusted cash account 510. Okay. Then the cash received during the month you will debit. Cash payment during the month you will sorry. Give me a minute. You have to debit the direct remittance here. What are the things that will come to adjusted cash control? Direct remittance, bank charges, and standing order. Okay. So then direct remittances are 125. Bank charges given as 5,000. Standing order payment 60. So you can balance off and find what is the opening balance of adjusted cash control. 5 plus 60 plus 510, that is 575. 575 minus 125, that is 450. So then, balance of the cash account before the receipt of bank statement 450. Adjusted balance of cash account 510. That is answer number 5. Answer number 5. Then moving on to the 10th one. Imali traders reported a gross profit of 250,000 and a net profit of 180,000 for the year ending 31st March 2025. Imali traders sells goods by keeping a 25% markup on cost during the month of March. The business dispatched goods costing 15,000 on sale or return basis. However, the entire sale value of this good has been recognized erroneously as sales revenue by the business. Out of this, goods costing 5,000 remained unsold as at 31st March 2025. And no adjustments were made in this respect. Okay. Closing stock was calculated based on physical stock count. Then you can prepare, okay, gross profit and net profit. The gross profit given is 250,000. The net profit is given as 180,000. We have recorded our entire goods that we sent on sale or return basis as a sale. Okay. And then now here 5,000 worth of goods have not been sold. It has not been sold. So then what you have to do, you have to add this to our closing stock net. Closing stock is certain based on physical stock count. You have to add this to our closing stock, and the sales value you have to deduct from sale. Or what you can do, okay, now see, the cost of the goods that are not sold out of the goods that we send to sale or return basis is 5,000. This 5,000 you have to add to cost of closing stock. Okay, you have to deduct from cost of sale. The selling price of that will be with 25% profit, right? Profit is how much? 25% of 5,000 is, that's the gross profit. 25% of 5,000 is 1,250. Okay, then the sales value of that will be 6,250. Then what you have to do, you have to deduct 6,250 from sales. Then that will reduce your gross profit. Okay, and the cost amount you have to deduct, you have to add it to cost closing stock. If you add that to the closing stock, your cost of sale will decrease, your gross profit will increase. Then what you can do simply without recording twice here, you can directly reduce the profit amount because of this. Because the sale or return basic goods were not sold, your profit is reducing by 1,250. Your gross profit, okay, is reducing by 1,250. Now, because your gross profit is reducing by 1,250, automatically, okay, your net profit also will reduce by 1,250 because whatever affects your gross profit will automatically affect your net profit. And the corrected gross profit will be 250,000 minus 1,250, that is 248,750. Net profit will be 180,000 minus 1,250, that is 178,750. So that is gonna be answer number 3. Answer number 3. Hope that one is clear. Then the 11th one, Mihiri Private Limited is carrying out a manufacturing business. The information relating to this business for the month of January 2025 is as follows. Okay, prime cost and total production cost. Then opening raw material is 80. Then purchase of raw material purchase is 750. Carriage inwards you will add to it. Carriage inwards 20. How much is the closing raw material? Minus closing raw material. Closing raw material 50. Then you will get the raw material consumed amount. Raw material consumed amount as 80 plus 750 plus 20 minus 50. That is 800. 800. And for that you can add your direct labor cost. Direct labor cost is given as 300, and then direct other also given. Direct other cost is given as 40. 40. Then you can get your prime cost. Prime cost will be, here they are saying the company policy is to measure the work in progress in production cost, not prime cost. If they say prime cost, you have to adjust the work in progress under prime cost. Then here 800 plus 300 plus 40, 1,140 is your prime cost. Then total production cost will be, now prime cost is 1,140. Factory overhead. Factory overhead is given as 400. Increase in work in progress. If the work in progress is increasing, you have to deduct that. Increase in work in progress 50 you deduct. Then you can get your total production cost. Total production cost will be 1,140 plus 400 minus 50, 1,490. 1,140, 1,490, that is answer number 4. Okay. 12th one, Nethuli Enterprises has not maintained accounting records properly. Inventories and trade data balances of the business as at 31st March 2025 and 31st March 2024 are given below. Okay. Inventory values are given, data values are given. All the purchases and sales of the business are made on credit. Okay. The business maintains a gross profit margin of 25% on selling price. total cash received from the debtor and cost of sale for the year ending 31st March 2025 were 470 and 300. The amount we got from debtor is 470. Amount we paid to uh, the amount we incurred as cost of sale is 300,000. Okay. Then now we have to find our purchaser's value and trade debtor value. Now how can we find the purchase value? Through cost of sale. You all know opening stock plus purchases minus closing stock will give you your cost of sale. Cost of sale. Cost of sale is given as 300,000 in the question. Cost of sale 300,000. Opening stock is 30. Closing stock is 50. You can reverse and find how much is your purchase value. 300 plus 50 minus 30. That will be 320. Now, how can you find the debtor's closing balance? You can prepare a debtor's account. Opening balance, sales, cash, amount, BCD. There is no any discount allowed here also. Opening balance is directly given as 190. The cash received from debtor 470. Now we can find the sale also. No, cost of sale is 300. The profit margin is 25% on selling price. Okay. Then selling price will be 100%. Selling price will be 100%. The profit you are calculating on selling price. Okay. Therefore, profit is 25% on selling price. Then if out of selling price 25% is profit, cost of sale will be 75%. Then 300 divided by 75 into 100, the sale value will be 400. Okay, this the total sales value. That means the profit is 100. Now this entire sale is done on credit, right? Then you can put here 400 and balance of 590, 590 minus how much was the cash? It is 470. 5, sorry, 590 minus 470. 590 minus 470. You will get the balance in the trade debt account as 120. Sales value, no, they are asking for purchase value 320. Debtor value 120. That is answer number 3. Answer number 3. Which of the following statements are correct in relation to goodwill of a partnership? Goodwill is estimated when there is a change in ownership of the partnership. Yeah, we estimate goodwill when there is a change in ownership. Change in ownership means admission of a partner or a retirement of a partner. Okay. Also, when there is a change in profit sharing ratio. Yes, second one. Goodwill is estimated when there is a change in the profit or loss sharing ratio of the partner. That is also correct. See, goodwill is estimated as per the section 24 of the partnership ordinance. No, the section 24 of the partnership ordinance doesn't give any statement connected to goodwill. Then D, goodwill is adjusted through the partner's equity. Yeah, right. The goodwill amount we are adjusting through the partner's capital accounts. That's equity. So A, B, and D are the correct statement. A, B, and D, answer number 4. Then moving on to 14 and 15. The goodwill of the partnership estimated on 31st March and the equity of the partnership after retirement of VAS. Then we'll prepare the partner capital account and we'll also prepare the partner current account. Partner current account. Okay. So we have Sam, Ram, Ram and Vas. Sam, Ram and Vas. Sam, Ram, Vas. Sam, Ram, Vas. Okay. So Sam, Ram, and Vas are carrying out a partnership sharing profit or loss in a ratio of 5 to 3 to 2, respectively. The following account balances were available on 1st of April. The opening balance of capital account BBF 6,000, 4,000, and 2,000. Current account balance, BBF, 800, 400, and 200. 800, 400, and 200. Okay. Then the partnership earned a net profit of 1 million for the year ended 31st March 2025. Was retired from the partnership on 31st March 2025. Okay. Then on this date, the goodwill of the partnership was estimated and it was adjusted through the capital account of the partner. Hmm. The total amount due to VAS at the retirement including his loan, was 3 million. Okay. Now will first of all now see here VAS is retiring at the end of the year, right? If he's retiring at the end of the year, you will have to transfer his capital account portion at the end of the year to the capital account. Then you have to complete the current account and now transfer it. He's retiring at the end of the year. You can't just transfer this 200. Now here there is no salary or interest on capital. Therefore, the entire net profit you can divide it based on the profit sharing ratio. Okay. Now here, already Vas and Sam has provided loans, okay, interest-free loans of 500 and 300. Okay, since they are interest-free loans, you won't give any interest for that. Okay, if they just say loan and they are silent, you will have to give 5% interest as per section 24. But if they specifically say interest-free loan, you are not going to give any interest. Okay, then the profit for the year was 1 million, you have to divide it based on the profit sharing ratio 5 to 3 to 2. That's going to be 500, 300, and 200. So then the balances are 1,300, 700, and 400. 1,300. Now here there is no any drawing, so paid amount, you can just directly keep it like this. But for working purpose, I'll show. Because it's a part 1 question, you don't have to complete the table. 1,300, 700, and Vas is retiring. So his amount we are transferring to capital account, 400. So we can transfer that to capital account, say current account, 400. Okay. Then here you will get goodwill amount. Then we are transferring the retiring partners amount to the loan account. And then for the remaining partners, you can find BCD. And here in the credit side also, you'll have goodwill based on the old ratio. Okay. Now, here they are saying the total amount due to Vas at the retirement, including his loan, was 3 million. Now, already Vas has 300,000 in his loan account. When he's a partner itself, he gave a loan of 300. Then, how much out of that, see that including that, the amount payable to him is 3 million. Then what will be the amount that we are transferring to loan account from the capital account? That will be 3 million minus 300,000, that is 2,700,000. Okay. Now Vas will not have a new profit sharing ratio. Then he won't have a goodwill based on the new ratio. He will have a goodwill only based on old ratio. You can balance off and find that 2,700, 2,700 minus 2,400. Here you will get the value as 300, his old goodwill ratio. Then old profit sharing ratio is 5 to 3 to 2. Then out of that, if 2 is 300, then how much will be 3 and 5? 300 divided by 2 into 3. Ram's amount will be 450 and Sam's amount will be 300 divided by 2 into 5, 750. Then you're going to write here 750 and 450. Then how much is the total goodwill? 750 plus 450 plus 300, that is 1,500. So the goodwill amount is 1,500, which is answer number 1. 15th one, the equity of the partnership as at 31st March 2025 after the retirement of Vas. They are asking the total equity of the partnership. Now we'll complete the capital account. So Total goodwill 1500. Now we should divide it based on new ratio in the debit side. New profit and loss ratio 3 is to 2. The 1500 if you divide 3 is to 2, that's gonna be 900 and 600. Now you can balance this off. 6750, 4450, 6750, 4450. Then 6750 minus 900, that is 5850. 4450 minus 600, you will get 3850. Now they are asking total equity, right? Total equity equals capital account plus current account. Capital account total. So only Sam and Ram, Vas is retiring. So 5850 plus 3850, that is 9700. Current account 1300 plus 700, that is 2000. So it's gonna be 11,700 your total equity. 11,700, answer number 3. Answer number 3. Then moving on to the next question. Ninth, yeah. The profit and the total comprehensive income for the year ending 31st March 2025, as per the draft financial statement of Nuwan PLC, were 8,500,000 and 6 million respectively. The profit they have calculated as 8,500,000. The total comprehensive income they have calculated as 6 million. Then, okay. Total comprehensive income. Here you have to take it like the total comprehensive income divides into 2 as profit after tax and other comprehensive income. Okay. Here the total comprehensive income was given as 8,500,000. Okay. Then during the current year, the land and machine were revalued for the first time and motor vehicle were revalued for the second time. Okay. The surplus and deficit resulted from this revaluation carried out during the current year were as follows. Now, land and machine were revalued for the first time, right? Then this 2000, you can put it here. Okay. Machinery's revaluation deficit will go to other expense. Okay. All right. Next. When motor vehicle second time, then we need to know what happened in the first time. We'll see. When preparing draft financial statement, this land revaluation surplus has been recognized in the profit or loss account within other income, and both above revaluation deficit have been recognized in other comprehensive income. Okay. The motor vehicle has been revalued for the first time on 31st March 2023, resulting a surplus of 1,200,000, and it has been correctly accounted for. Okay. Last year there was a surplus from the motor vehicle 1,200,000. This year there is a deficit of 1,500. So then last year's surplus less than this year's deficit. Then this entire surplus amount you can set it off under other comprehensive income. Okay, you can set it off under other comprehensive income. Then the remaining 300 will go to other expense in profit or loss. Then the total OCI amount will be 800. Other comprehensive income will be 800. Now here profit has been, sorry, here total comprehensive income is only 6,000. Profit has been calculated as 8,500. Okay. Then what has happened now? The machine deficit. When preparing draft financial statement, land revaluation surplus has been recognized in P&L within other income. Okay. Now the land surplus they have recorded in other income. So you remove that from here. Okay. From profit you remove that and only you put to OCI. And then both the deficit has been recognized as other comprehensive income. Now the machinery first time deficit should be deducted under other expense, right? Here minus 1,000. Okay, and then out of this year's deficit of 1,500, we set off 1,200 in OCI. The remaining 300 deficit should be deducted from other expense, under other expense. Then what will be the corrected profit for the year? 8,500 minus 2,000 minus 1,000 minus 300. That will be 5,200. Still, the total comprehensive income will be 6,000. The correct profit for the 5,200, corrected OCI 800, total comprehensive income will be 6,000. Okay, then profit for the 5,200, total comprehensive income 6,000. That is answer number 1. Then 18th one, Kamal PLC was incorporated on 1st of April 2024 and it imports and sells a computer. The company is registered for VAT. The following cost has been incurred. What are they asking finally? The cost of inventory as at 31st March 2025. First of all, we'll find the cost of the purchase. Purchase price 55,000. Freight and insurance you will add. Freight and insurance 10,000. Freight and insurance 10,000. Import duty you will add. Import duty 15,000. VAT. Now this is a VAT registered business visa. The VAT amount will go to the VAT control account. Storage cost. If they just say storage cost, you will not add. Okay, storage of raw material, you won't add it. Sorry, storage cost. Yeah, storage cost is excluded cost. You won't add it. Administrative overhead to import the computer, you won't add it. Okay, then the cost of the inventory that we purchased are 55,000 plus 10,000 plus 15,000, that is 80,000. Now what are they saying? Out of this computers cost, 80% of the computers are remaining in the closing stock. Now here they are asking the cost of inventory as at 31st March. Now they are asking the closing stock. How much is 80% of this? 80% of that will be 64,000. That is answer number 1. Your closing stock will be 64,000. 19th one. Which of the following statements are correct as per LKAS 7 statement of cash flow? Interest received may be classified as an invested cash flow. Yeah, interest income is an investing cash flow. Interest paid may be classified as operating cash flow. Interest paid we record under operating cash flow. No doubt, no for those. Dividend received may be classified as an operating activity. Normally, dividend received is a investing activity. But then here they are using the word may be, right? If you want, you can classify as an operating cash flow. No one is going to stop you. Now, in case investing in other companies and getting dividend for your as an income is one of the main activities of your business, that can be your operating cash flow, right? It doesn't have to always be investing activity. Now, what if they say dividend received is a operating cash flow? Then it might be wrong. Now here they are using the word may be, right? It could be classified as operating cash flow. Therefore, it is correct. Okay. Then D. Dividend paid may be classified as a financing cash flow. Yeah. When you pay dividend, that is a financing activity. Therefore, all are correct. Answer number 5. And the 20th one. The total equity of Natasha PLC as at 1st of April 2024 was 9,500,000. Following information related, okay, they had given the opening equity, certain transactions, and they are asking the correct total equity as at 31st of March. Closing equity, okay. Opening equity given. Opening equity given as 9,500,000. The total comprehensive income for the year was 5,500,000. Total comprehensive income will increase your equity plus total comprehensive income 5,500,000. Retained earnings capitalized during the year. Retained earnings capitalized means that bonus issue, right? Retained earnings will reduce and stated capital will increase. Retained earnings is also your equity. Stated capital is also your equity. one equity component is decreasing and another equity component is increasing. Therefore, this will not change the value of your equity overall. Interim dividend paid for the shareholders minus minus interim dividend 800, and then proposed final dividend. Proposed dividend you will not record, right? Proposed dividend you will not record in your financial statement. Therefore, closing equity will be 9,500 plus 5,500 minus 800, 14,200. Answer number 5. Moving on to 21 and 22. Use the following information to answer question number 21 and 22. Okay. Suranga PLC sells a special type of electric generator which requires specialized knowledge for installation. Accordingly, the installation of these generators is done only by Suranga PLC. Now remember here, Suranga PLC is giving electric generators. And to install that generator, they need special knowledge. And only they can install the generator. Now, when we are recognizing revenue, we'll recognize the revenue if the control of it is passed to the customer, right? If the control of it is passed to the customer. Now, if Suranga PLC didn't install the asset, okay, they can't control it. They can't use it. To control, they should be able to use and get the benefit out of it. Now, if Suranga PLC didn't install it, the customer cannot use it. Therefore, because they can't call anyone else to install also, no, only Suranga PLC can install it. Then what will happen? You will recognize revenue only when it is installed. Okay. Any uninstalled goods if you give, you can't recognize as revenue. To recognize as revenue, you have to give the machine as well as install it. Remember that. Then uh, further, a maintenance service is required 9 months after the installation of the generator. The maintenance service could be provided by any electric generator supply in the market. Okay, so maintenance service, okay, can be done by anyone. So maintenance service you can treat as a separate performance obligation. Okay, then the total revenue to be recognized for the year ending 31st March 2025. Okay, how much can we recognize as revenue? We have sold 28 generators. Out of that, only 24 generators were installed. Now I said that here to recognize as revenue, you have to sell the generator as well as install it. And how many generators are sold and installed? Only 24, right? Out of these 28, only 24 are installed. And you will recognize revenue only for 24 generators multiplied by, you can treat both of this as one performance obligation. The price will be 3,000. The price will be 3,000. Okay. Then 24 generators into 3,000. So that means 24 generators into 2,500 and 24 generators into 500. So I took this as one performance obligation, that is 3,000. And how much can you recognize income from the generators installed? 72,000. Then maintenance service 12 are provided for 400 each. That will be 400,000. 400,000 into 12, 4,800. Then revenue recognized will be 76,800. Answer number 2. Answer number 2. And that was easy. Then 22 is only little confused. But easy. The following additional information is also provided. If a customer purchases generators from this company and also agrees to obtain the maintenance service, a 10% discount is given on each unit price or charge given above. Okay. If you are taking the machine with installation and maintenance all together, you will get a 10% discount from the entire transaction. Then we have to find the allocated discounted price right now. Generator price is 2,500. Installation price is 500. Maintenance price is 400. Total, if you are buying each of these individually, you will have to pay 3,400. If you're buying all three together, you're getting a 10% discount. So minus 10%, 340, 3,400 minus 340, 3,060. So from each of this item, you can deduct 10%. 2,500 minus 250, 2,250. Installation minus 10%, 450. Here, 400 minus 40, 360. These are the discounted prices. Okay. Now they are saying 24 generators sold and installed during the year include 10 generators sold subject to this discount. Out of these 24 generators, 10 generators are given subject to that discount of 10%, while the remaining 14 generators are given in the normal basis. And however, by the end of the year, the maintenance service has been provided only for 6 of these generators. Okay, that means out of these 12, 6 generators relate to the discounted price. Okay, remaining 6 are from the normal price. Then they are asking the total revenue to be recognized for the year ending 31st March 2025 as per the SLFRS 15 based on the discount after considering the discount. Okay. Now here they are saying out of these 24 generators installed, 10 generators relates to the generators given with discount. So here the discount generators price is 2,250, installation price is 450, both together that will be 2,250 plus 450, 2,700. So discounted generators installed and sold 10 generators into 2,700, that is 10 into 2,700, 27,000. Okay, so the actual total revenue recognized, we totally installed 24 generators. Out of that, 10 are connected to the discount. The remaining 14 will be given in the normal price of 3,000. Then 14 into 3,000 will be 42,000. And that's thing, out of the maintenance service provided, only six have been given with the discount. Then 6 into discounted price of maintenance 360, that will be 2,160. And then for the remaining 6 here, totally we have given 12 maintenance price. Remaining 6 you will give in the normal price of 400. So 400 into 6 will be 2,400. Then now what will be the correct total revenue? That will be 27,000 plus 42,000 plus 2,160 plus 2,400. 73,560. That is answer number 1. Answer number 1. Then moving on to question number 23. Earnings per share, inventory turnover and interest cover. Okay. Earnings per share equals to profit for the year divided by number of shares. Okay. Profit for the year is how much here? Profit for the year. Given. Here. Return on equity 18%. What is return on equity? Return on equity means how much percent you are getting as your profit compared to your equity, right? Return on equity is 18% of equity now. That means your profit is 18% on equity, right? Equity is 12,000 and 18% of 12,000 is 2,160. This is 15,000. Then your profit for the year is 2,160,000 divided by how much is the number of shares. Indore PLC was incorporated on 1st of April by issuing 1 million shares divided by 1 million shares. Then how much is your EPS? Rupees 2.16 per share. That is answer number 2. Answer number 2. Then 24, inventory turnover ratio and interest cover ratio. Okay. Inventory turnover ratio equal to cost of sale divided by average inventory. Cost of sale is given as 4,500,000. Average inventory will be okay. Here we have to find our inventory. Now current asset. To find out the average inventory, you need to find it through the current and quick ratio difference. Okay. Now then, see here, they have not given liability for us to find current liability. We'll find it. Now asset equals to equity plus liability. Total assets are 21 million. Equity is 12 million, which means your liability will be 9 million. 9 million. Now, out of this, how much will be non-current liability? How much will be current liability? Non-current liability is, see here, debt to equity ratio is 60%. Now, debt means here they are talking about non-current liability. They are telling here non-current liability is 60% of your equity. That is what debt to equity ratio means. Now, how much is 60% of equity? 0.6 into 12,000. That is 7,200. So, out of your liability of 9,000, non-current liability is 7,200. How much is your current liability? 9,000 minus 7,200. Current liability is 1,800. Okay. Now, here your current asset is 3,000. How much is your quick asset? Quick asset. Quick asset ratio equals to quick asset is to current liability. Okay. Here quick asset ratio is given as 1.25. That means now your current liability is 1,800. That means your quick asset is 1.25 times of your current liability. So 1,800 into 1.25, that is 2,250. 2,250. Then you can find your, now see there's, now you know the difference between your current asset and quick asset is your prepaid expense and closing stock, right? Now here they are saying there are no prepaid or accrued expenses at 31st March 2025. Then the difference between your current asset and quick asset of 750 connect to your closing stock. Okay, closing stock. Now normally if there is, now normally average inventory will be opening stock plus closing stock divided by 2, right? Now here this is a newly started business. Because it's a newly started business, there will not be any opening stock. If there is no any opening stock, okay, what we are going to do, directly take the closing stock amount as your opening average inventory. Don't go to divide that by 2, okay? Whether it is debtor, whether it is creditor or closing stock. At a situation when there is no any opening balances of those three items and they ask for the average of it, you take that exact closing amount as the average. Don't go to divide it by 2. If you have the opening and closing balance only, add the opening with closing and divide by 2 and find the average. And how much will be the inventory turnover? 4,500 divided by 750. 4,500 divided by 750, that is 6 times. Okay. Then next you have to find interest cover ratio. Interest cover ratio will be profit before tax plus interest divided by interest. How much is your profit before tax? Now here say your profit for the year you found as 2,160,000. For the profit for the, if you add the income tax of 540, you will get your profit before tax as 2,700 plus interest. How much will be your interest? ordinary share, and on the same date, see here, debentures with 5% annual interest were also issued. There were no any other long-term liability in the company. That means the only long-term liability, the only non-current liability is your debenture. For that debenture, you should give a 5% interest. Then what will be your interest? 5% of 7,200, that is 360. So plus interest 360 divided by 360 interest. How much will be your interest cover? 2,700 plus 360 divided by 360, that is 8.5 times. So then 6 times and 8.5 times, that's answer number 3. Answer number 3. Okay. Then the 25th one, which of the following equations are correct relation to classification of cost? Okay. Total variable cost. Direct material cost, okay, that will be variable per unit. Variable direct labor cost plus variable other direct cost plus variable production cost and variable non-production cost. Those are the only variable cost you have. So this is correct. Total variable cost include all of that. Total cost will equal to prime cost plus production overhead plus non-production overhead. So production overhead plus non-production overhead is your total overhead. So yes, your total cost is equal to prime cost plus total overhead. If not, product total cost is equal to variable cost plus other cost, that is variable cost plus fixed cost, that is also correct. So B is correct. C, total cost equal to direct variable cost plus direct material cost plus direct labor cost plus other direct cost. So here, direct material, direct labor, and other direct gives you your prime cost. Total overhead includes your production overhead and non-production overhead. So it's same as the B. Total cost equal to prime cost plus total overhead. C is correct. Total fixed cost equal to fixed direct labor cost. Okay. Fixed other direct cost, and then fixed production overhead and fixed non-production cost. Correct. Then answer is all 5 are correct. Okay. Then moving on to 26. They're asking for the basic salary and the total deduction. Then the payroll of a company, has been destroyed completely due to floods. Hence, the company was able to obtain only the following information for the month ending 30th of June. Okay. The total amount remitted for both EPF and ETF fund relevant for the month was 168,000. When they say total EPF and ETF remitted, okay, that's the total amount of EPF and ETF payable. Okay, so that will include the EPF employee and employer contribution and ETF employer contribution. So all three. Okay. Then the cost of living allowance 125. This is the only allowance. The total subscription of welfare society deducted from the employee salary was 40,000. Okay. Now here employee EPF. Employee EPF is 10%. Employer ETF is 15%. And then you have the employer ETF of 3%. This totally only the EPF and ETF remitted amount. That is how much? 28%. 28%. That total amount is given here as 168,000. Okay. Then how can you find each individually? 168,000 divided by 28% into 10%, you will get as 60,000 employee contribution. Employer 168 divided by 28 into 15, that will be 90,000. And then the remaining 18,000 is the ETF contribution of employer. Okay. So what are they asking for? Okay. So the EPF and ETF are calculated on the gross salary. Then gross salary will be 100%, right? Gross salary 100%. 100%. How much will be the gross salary? Gross salary will be Now 168 divided by 28 into 100, gross salary will be 600,000. Okay. Then uh, they're asking basic salary and total deductions now. Now gross salary will include the basic salary and other allowance, so other earnings. Now here the only other allowance given is the cost of living allowance of 120,000. If the cost of living allowance is 120,000, basic salary will be 480,000. 480,000. How much is your total deduction? What are the deductions you do from gross salary to get your net salary? Employee contribution to EPF is a deduction from the gross salary. Sorry, employee 60,000. And then there is this uh, subscription for welfare deducted from employee salary 40,000. Okay. Then if there's any staff loan or salary advance, all of those are deductions. Okay. So here employee contribution 60, subscription for welfare society 40, total deductions are 100,000. So basic salary 480 and deduction 100,000, answer number 2. Just in case they are for net salary, now gross salary is 600, deductions are 100,000, therefore net salary would be 500,000 if they ask. Okay, then uh, moving on to the next question, 27. Which of the following statements are correct in relation to overheads? Okay, variable overheads are not directly traceable to a product. Wrong. Variable overheads are directly traceable from a product. Variable means per unit, so you can find it easily for 1 unit. Okay, so that's wrong. Charging the overhead collected for the cost center to a cost unit based on an appropriate basis is known as allocation of overhead. Wrong. Allocation of overhead is when the overhead for each department is directly given. Dividing the overhead to cost centers based on appropriate basis, like electricity, or dividing based on kilowatt hours and all that, are called appropriation. So this is also wrong. Sorry. Here, this is variable overhead, not just variable cost. Normally, variable cost are the items that change with the increase in what? Increase in the unit. Now, here, variable overheads are not directly traceable to a product. That is correct. For example, variable overheads, you can take painting expense. Okay, paint is variable, right? When the number of products increases, the amount of paint you need increases. So that's a variable cost. But then can you calculate how much is the cost of what? How much is the value of paint for one particular unit? It will be difficult, right? It will be difficult to figure out how much is the cost of paint incurred for 1 unit. So it's not directly traceable to a product. Okay, then only direct costs are the prime costs are only directly traceable to a product. Okay, variable cost, sorry, overhead costs are not directly traceable to a product, even though it is variable or fixed. Then C, non-production overhead should be absorbed into products only as a percentage of prime cost. No. If you want non-production cost also, you can calculate as a OIR based on machine hours, labor hours, or based on the number of units, and absorb it to the unit. Okay. Then D, commonly incurred production overhead like electricity among cost are apportioned among cost centers using an appropriate base. That means like electricity you are using kilowatt hours, rent you are using floor area. That is correct. So what are the correct statement? A and D, answer number 2. Answer number 2. 48. Which of the following statements are correct in relation to CVP analysis, the marginal costing? A, the total variable cost is higher than the total revenue before reaching break-even point. No. Okay. Total cost is higher than the total revenue before reaching break-even point is correct. Total variable cost is higher than total revenue, wrong. Okay. always the total revenue will be more than your total variable cost. Okay, this is wrong. B, at the break-even point, the total contribution is equal to total fixed cost. So, profit equals to total contribution minus total fixed cost. If at break-even point the profit is zero, that means your total contribution is equal to total fixed cost. That is correct. C, at a profit is earned within the range of margin of safety. Yeah, margin of safety is the unit that you sell beyond your break-even point. So yes, whatever you sell beyond your break-even point, you will get a profit. Whatever you sell below the break-even point, you will get a loss. Then D, the total revenue is equal to the sum of total contribution and total variable cost. So now, revenue minus variable cost equal to total contribution. Then total contribution plus variable cost will be revenue, right? So total revenue is equal to sum of contribution and total variable cost. That is correct. So B, C, and D, that will be answer number 4. Answer number 4. Then 29. Situm PLC produces a single product and its annual capacity level is 5,000 units. Following information relates to this product. Okay. The total cost at the activity level of 1,000 units and 2,000 units are 200,000 and 250. Okay. Quantity, total cost. At a quantity of 1,000 units, your total cost was 200,000 itself. At the quantity of 2,000 units, your total cost was 250,000. So remember, most of the time your total cost will change because of your variable cost, right? Now your total cost is changing by 50,000 when you change the quantity by changing quantity by 1,000. Then how can you find the variable cost per unit? Variable cost per unit will be equal to the change in total cost divided by change in quantity. The total cost is changing by 50,000, quantity changing by 1,000. That means your variable cost per unit is rupees 50. And what are they asking? What is the profit or loss? Okay. If the activity level exceeds 2,500, the company has to bear an additional fixed cost of 50,000. Okay. Now profit equals to total contribution minus total fixed cost. How much is your selling price now? Selling price minus variable cost will give you your top contribution. Okay. Now your variable cost per unit is 50. So that's in the contribution to sales ratio is 60%. Then your contribution is 60% of your selling price, then selling price will be 100%. And out of your selling price is 60% is your what contribution. The variable cost will be 40% of the selling price. How much will be the selling price? 50 divided by 40 into 100, that is 125. So 125 minus variable cost 50, your contribution will be 75. Then your total contribution will be 75 into, now here they are telling to find the profit at 3,000 units. Contribution per unit 75 into 3,000 units, that will be 225,000. Minus what will be the total fixed cost. Now we'll find out how much is the total fixed cost at 2,000 units. You can say at 2,000 units, total fixed cost will be equal to the total cost minus total variable cost, right? At 2,000 units, total cost equal to 250,000 minus total variable cost will be how much? For 1 unit, variable cost 50 into 2,000 units, variable cost total will be 100,000. Therefore, the fixed cost will be 150,000. 150,000. Okay. Even if you substitute like this the same way for 1,000 units, you will get the fixed cost as 150,000. Now, what are they saying? If the activity level exceeds 2,500, if they start to produce more than 2,500 units, you have to incur an additional fixed cost of 50,000. Okay. Now here you are going, they asking the profit at 3,000 units, right? Then the fixed cost you have to increase by 50,000 because 3,000 is more than 2,500. Now at 2,000 units, your fixed cost was 150,000. Now because they are asking the profit of 3,000 units, you will have to add another fixed cost of 50,000. Your total fixed cost will be 200,000. Profit will be 25,000. Then variable cost per unit 50. Profit will be 25,000. That is answer number 1. Answer number 1. Then 30th one. Then the 30th one, which of the following statements are correct as to the evaluation of long-term investment project? So then, A, the value of the initial investment of a project is equal to its present value. So yeah, in year 0, the cash flow of year 0 is called initial investment, right? The present value of the year 0 will be equal to that initial investment amount, right? There is not going to be a difference because the value of money today will be equal to the value of money today. There will be a difference in the value of money, right? In year 0. So that is correct because the discounting factor of year 0 is 1, always 1. Then B, when the NPV of the project is 0, it generates a return equal to its expected rate of return. Remember, expected rate of return means expected rate of return is the percentage or the rate at which NPV is 0. Okay, expected rate of return is the percentage. Okay, the discounting rate at which when you multiply your cash flows, you will get an NPV of 0. So yes, when the NPV is 0, it generates a return equal to the expected rate of return. That is correct. Then C, cash received at the present, cash received at present for a project is more valuable than the same amount of cash received in the future. No. Okay, the value of money keeps on depreciating, right? So the cash you get today won't be equal to that same cash amount you get in the future. Then D. Okay. Here they are saying cash received at, I read it as equal. Cash received at the present for a project is more valuable than the same amount of cash received in the future. That is correct. I read it as equal. Okay. See, getting 5,000 today is more valuable than getting 5,000 after 5 years, right? That 5,000 today, no, 5,000 if you get in the future, the value of that 5,000 will be low compared to that 5,000 you get today. Then D, when a project is evaluated based on the net present value, it considers only the net cash inflows received until its initial investment is recovered. This is wrong, right? That is the definition of payback period. Okay, in net present value, we are taking the cash flows of the entire project from year 0 until the end of it. Let's say the investment is 5 years. Until 5 years, you will take the cash flows and multiply by discounting factor to get the net present value. In payback period only, we consider only the cash flows until the investment is recovered. Whatever the cash flow after that payback period, you don't consider for payback period. Then the answer is A, B, and C. That is the third one. Third one is the answer. So now MCQs are done. Moving on to the short answer question. The several purposes for which the stakeholders of a firm obtain information from the general purpose financial statement are given below. A, to assess the profitability of the firm. Who wants to know the profitability of the firm? That's the investor. C. B, to assess the firm's ability to settle loans. That is the lender. Lender wants to know if the loans he gave can be recovered back. 3. To enforce income tax on the firm, that is government. C2. To assess the firm's ability to provide the service reliably, customer. 1. 32. Madhu Enterprises commenced its operation on 31st March 2024, and this business was financed entirely through a bank loan of 400,000. The following asset, liability, and equity balance were available as at 31st March 2025. Okay, here they have given the closing asset, liability, and equity. Asset equals liability plus equity. Okay, closing asset is given as 575. Closing liability is given as 300. And closing equity is given as 275. Okay, then during the year, total asset has been increased by 500. Okay, wait, first of all, the business was financed entirely from a bank loan. Okay, when they are starting the business, okay, the opening liability was 400. There was no any equity. The entire assets were financed. Okay, entire business was financed through the bank loan. And opening asset also will be 400,000. No, wait. Uh, yeah, opening asset will be 400,000. So, opening date is 1st of April 2024. So, they started it one day before that. Then, opening asset will be 400,000 because asset equals liability plus equity. There is no any opening equity. Okay. During the year, total asset has been increased by 500,000, which includes 200,000 contributed by the owner of the business as capital. So during the year, totally the asset increased by 500. They are not saying total asset increased by 500. Asset increased by 500 because of owner's capital and some other reason increase. On the other hand, again, the asset decreased due to the owner's drawings, repayment of the loan of 100,000 and expenses of the business. Okay. Now here, see, um, owner's additional capital is 200, equity plus 200. Okay. The remaining amount may be because of income. We'll see. Then, on the other hand, owner's drawings 25 minus 25, and they are paying liability of 100,000. Okay. Now we need to find out our expense. Okay. Before that, we can find our profit. Profit equals closing net asset minus opening net asset plus drawings minus additional capital. Closing equity is 275. Opening equity is 0. Drawings is 25. Additional capital is 200,000. Therefore, your profit will be um, profit will be 100,000. 100,000. How much will be the expenses? Now we know our total asset increased by 500. Okay, maybe because of capital. Here capital introduced capital, and other one maybe because owner. The remaining sorry, income. The remaining 300 increase in asset maybe because of income. Then by how much did the asset decrease during there? How do you find that? 575 minus 500 minus 400. Asset decreased during the year by 325. Now, the asset decreased due to owner's drawings of 25, decreased by 100 due to payment of loan. Then the remaining decrease only should be due to expenses. How much is that? 325 minus 25 minus 100. That's going to be 200. Then expenses are going to be 200,000. That was actually an interesting question. Then next, state the prime entry book to record transaction ABCD. Okay, prime entry book or books. A. Purchase onion seeds 800,000 on credit from Amal, a seed supplier. Okay, then that is gonna be, now what is this business? Onion cultivation business. So purchase of onion seeds on credit will go to purchase journal. Purchase journal. B. Purchase a harvesting machine on credit. Purchasing a non-current asset on credit will go to general journal. General journal. Then C. Paid 100,000 wages. Cash payment journal. Cash payment journal. D. Sold onion stock to a wholesale trader for 980,000 on credit, for which 200,000 cash was received. The balance amount is due on 1 month notice. Out of, you are selling on credit for 980. Out of that 200 you got in cash, the remaining 680 will be sold. You will get next 780. Okay. Then there you will record that. Now here they are asking primary book or books. You will have to say sales journal for the credit sale, and for the amount you got in cash, you have to say cash receipt journal also. Cash receipt journal as well. Okay. 34. Write the double entry required to record the following. A. Post the total of sales journal. So total of sales journal means you should get the total credit sales. Here sold onion stock to wholesale trader for 980 on credit. Now initially you sold on credit. After that you got 200 in cash now. Then this entire 980 is a credit sale. Anything else? Again sold an onion stock of 280 on credit to Amal. There is another credit sale. Then totally the credit sales are 980 and 280. 980 plus 280, 1260. So that will be trade receivable account. Trade receivable account. Debit 1260. Sales account. Credit 1260. Then B. To settle the amount payable to Amal. How much should we pay to Amal? We'll see what are the transactions from Amal. We purchased, here F1 is saying paid the balance amount due to Amal. Now see purchased 800 from Amal. Okay. And here again we are selling to Amal for 280, right? Now on credit and agreed to set off this amount against a part of the amount payable to Amal. Now we have to pay Amal 800. He is our creditor for 800,000. Now we are selling goods worth 280 to him. Then there he is becoming a debtor. The remaining amount you are paying in cash. 800 minus 280. You are paying 520 in cash. Now you are settling the entire amount to Amal, right? Then what's going to happen? Here, what are they asking? The double entry to record the settlement of total amount payable to Amal. Now your Amal, you are settling 800 as a creditor. Then the creditor's amount will reduce. Trade creditor or trade payable account, debit 800. Out of that amount, 280,000 you're setting off against the debtor amount he has to pay you. Trade receivable will be credited by 280. Then how much should you pay in cash to Amal? Cash control account, credit 800 minus 280, 520. Okay. And 35. State the appropriate elements of the financial statement for each of the following accounts maintained in the general ledger of a firm. Carriage inwards is an expense. Return inwards. That means you sold goods and the customer is returning back. Okay, sales is an income. Then return inwards also a negative income. So you're just gonna say income. Okay, asset revaluation surplus. Asset revaluation surplus is an income. If they just say revaluation reserve, then only it's equity. Okay, surplus or deficit is income and expense. Revaluation reserve is only equity. Provision for warranty is a liability. 36. State the accounting concept that is most appropriate to each of the following situations of a manufacturing firm. Recognition of depreciation for the machinery used in the production process as expense. So recording depreciation as expense is from the matching concept. Matching concept. B. Preparation of general purpose financial statement annually. Periodicity concept. Preparing annually. Preparation of a note to the financial statement to reflect the movement occurred in PPE during the year. So notes to the financial statement are mainly prepared to reveal certain information. That is called disclosure concept. To disclose, to reveal. Disclosure concept. D. Non-recognition of 500,000 compensation which is expected to be received by a firm due to pending litigation. We have filed a case against someone and they are saying expected to receive 500,000, not sure. Okay, so that is based on prudence concept. Prudence concept is saying not to overcast your income or asset. Okay, so that's based on prudence concept. In 37, the following transaction took place in a sports club during the year. What are they asking for? Depreciation of sports equipment and recognition of donation as income. Okay. We received a donation of 300,000 on 30th of November to purchase a sport equipment and it was credited to the sport equipment donation fund. Okay. Purchased the sport equipment worth 200,000 for cash. Using this donation, the expected useful life of the machine is equipment is 5 years. Then what will be the depreciation? See here, you're purchasing the equipment on 1st of January. They're asking for the double entry as at 31st of March. Then for the year ending 31st March, if we purchase the sport equipment on 1st of January, we are calculating depreciation as at 31st March. That's going to be for 3 months. Now for 1 year, the depreciation will be 200,000 divided by 5. For 1 year, it is 40,000. Then for 3 months, that's going to be, wait, 200 divided by 5 divided by 400. Hmm. Okay. So here the sport equipment cost is 200 divided by 5. The annual depreciation is 40. Annual depreciation is 40. Now you want to find a depreciation from January to March, that is 3 months. And 40 divided by 12 into 3, that's gonna be 10,000. 10,000. Okay, and you're gonna say here depreciation expense debit 10,000. Here they're saying to write in 1,000. Accumulated depreciation account. Accumulated depreciation account will be credited by 10,000. Then next, recognition of donation as income for the year. Now, we received donation worth 300. Out of that 200,000 we used to purchase equipment. And we also paid the advance of 50,000 using the donation on 25th of March. I mean within this year to purchase another sport equipment. This sport equipment is expected to be received on 5th of April. So next year. The policy of the sports club is to recognize donation as income to the extent that is used to make the payments during the year. So how much of the fund did we use to make payments? 200,000 we paid. Okay, 200,000 we paid to buy equipment. Another 50,000 within the year we paid to get as an advance for which we will get the equipment next year. Right? And totally how much is the amount we paid out of the fund? 250,000. Then you have to recognize that as income. Now you have to deduct it from your sport equipment fund. Okay. Then sport equipment fund is an equity when it's reducing debit. So sport equipment fund account will be debited by 250,000, and you will recognize that as an income in income and expenditure account. Income and expenditure account will be credited by 250,000. Then next, use the following information to answer question number 38 and 39. Then, before adjusting the goodwill, the capital account balances of Amal and Bimal as at 1st of April and the amount contributed by Cyril. Okay. Amal Bimal carried out a partnership sharing profit or loss in the ratio of 5:3, respectively. Cyril was admitted as a new partner on the opening date. On this date, the goodwill of the partnership was estimated as 2,400,000 and it was adjusted through the capital account. In the new partnership, the profit or loss are shared among Amal, Bimal, and Cyril in the ratio of 3:2:1 respectively. Okay, the capital account balances of the three partners as at 31st March. Now see here, goodwill was adjusted through the capital account and they have given the closing capital balances. That means the capital account balances are the balances after the goodwill adjustment. This is not the opening balances. So then capital account Amal Bimal Cyril partners capital account. You will find opening balance, then the cash invested by Cyril, the goodwill adjustment based on the old ratio, goodwill balance, goodwill amount based on new ratio, finally BCD. Now BCD is given 8,700, 6,600, and 3,600. Now goodwill based on the new ratio 3:2:1. Goodwill 2,400 divided by total ratio 6 into 3. It's gonna be 1,200, 800, and 400. Based on all ratio between Amal and Cyril, that's gonna be 5:3. 2,400 divided by total ratio 8 into 5, 1,500 for Amal and 900 for Bimal. Now you can sorry, that should be the goodwill amount. 1,500, 1,500, and 900. Okay, now balance this off. 1,200 plus 8,700 is 9,900. Bimal 800 plus 6,600 is 7,400. Cyril 400 plus 3,600, that is 4,000. Then 9,900, 7,400, 4,000. And the opening balance of Amal will be 9,900 minus 1,500, that is 8,400. Bimal 7,400 minus 900, that will be 6,500. And Cyril is a new partner, he won't have opening balance, instead cash invested by him will be 4,000. So then they are asking for the opening balance before adjusting the goodwill of Amal and Bimal and how much did Cyril contribute. That is 8,400, 6,500, and cash 4,000 given by Cyril. Then the profit of the partnership was 2,820,000. Each partner is entitled to a 10% annual interest. Okay, then profit for the year 2,820,000. From this, you have to deduct the interest on capital between Amal, Bimal, and Cyril. So 10% will be from the, they are saying 10% interest on capital balance after adjusting goodwill. Then closing balance 870, 660, and 360. If there is no partner's salary, the remaining amount will be distributable profit. Based on profit share, distributable profit. Then 2820 minus 870 minus 660 minus 360, that will be 930. Then this distributable profit you have to divide between Amal, Bimal, and Cyril. Now Cyril joined in the beginning of the unit, and for him also we are giving interest on capital and distributable profit. Amal, Bimal, and Cyril in the ratio of new ratio 3 is to 2 is to 1. Then 930 divided by 6 into 3, 465 for Amal, 310 for Bimal, 155 for Cyril. What are they asking? The profit share of Amal and Bimal. Amal 465, Bimal 310. So that is done. Partnership done. 40th one. Complete the following sentence as per the conceptual framework for financial reporting. Financial statements are normally prepared on the assumption that the reporting entity is a going concern. The main concept is going concern. Then B, an expense is a decrease in asset or an increase in liability that result in the decrease in equity other than those relating to distributions to holders on equity claim. Any decrease in asset or increase in liability other than drawings is an expense. Then C, blank is an enhancing qualitative characteristic achieved when independent observers could reach consensus that the financial information is faithfully represented. That means individual independent people, they can so each person, each independent party, they can read and understand that the information is properly faithfully presented. Therefore that is understandability. You're being able to understandability. You're coming to a conclusion. Consensus means you're coming to a conclusion that the information is faithfully represented. How can you come to a conclusion? Only if you understand the financial statement. So that's understandability. Then 41, state whether each of the following statement is true or false as per LKAS 1. An entity should present a complete set of financial statements at least annually. True. Okay. You can prepare your statement monthly. You can prepare a statement for a quarter. You can prepare statements for a 6 months. But at least minimum you have to prepare for 1 year. Okay. That's the standard. B. An entity should not offset income and expense when preparing financial statement unless required or permitted by another standard. You can't offset, for example, you can't say discount received and you can't deduct your discount allowed. Now, for example, let's say discount received is 100, discount allowed 50. You can't deduct and say net discount as 50 and record this as income. That is wrong. You have to show the discount received and discount allowed separately. So this is true. You can't offset. An entity should not offset income and expense unless the standard is telling you to do such a thing. An entity can rectify inappropriate accounting policies by disclosing them in the notes to the financial statement. If they use any inappropriate accounting policy, yes, they can disclose that in the notes and tell that to their stakeholders. D. Other comprehensive income comprises items of income and expense that are not recognized in the P&L or permitted by other accounting standards. For example, revaluation surplus of first time or second time, and setting off last year surplus with a current year deficit. Okay, those are income and expenses which are not recorded in the P&L. It is recorded in OCI. That is true. All these statements are true. Then 42. The information of 2 pending court cases relating to Ruan PLC is given below. Okay. A former employee has filed a case against the company asking for compensation of 8 million due to a dispute arose at the termination of the employment. According to the company lawyer's opinion, there's a very high probability that the company would lose this case, and it is estimated that the company is required to pay 6 million. Okay, then now here a provision of 6 million should be made. Okay, there's a high chance we have to pay next. So a provision of 6 million should be, what's the word here? Recognized in the financial position. You have to recognize 6 million provision in the SOFP of 1. B. The company has filed a case against the supplier asking for 5 million for the supply of inferior quality or low quality raw material. According to the company lawyer's opinion, there's a high probability that the company will win the case. Remember, this is a contingent asset. If you file a case and there's a probability you will get, okay, that's a contingent asset. So here, a contingent asset of 5 million should be disclosed in the contingent asset. We are not recording as asset. Instead, we are disclosing in the note to the financial statement. 43. Again, true or false. State whether each of the following statement is true or false as per SLFRS 16. At the commencement date of the lease, the lessee should measure the right of use asset at cost. True. The right of use asset value should be measured at the cost of it. B. At the commencement date of the lease, lessee should measure the lease liability at cost. No. Lease liability should be measured at the present value of the lease payment. The present value of your lease installment. This is false. After the commencement date of the lease, the lessee could measure the right of use by applying either cost model or revaluation model. That is true, right? Initially, you have to measure the whether it's PPE or ROU. Initially, you should measure it at cost. Okay. Subsequently, after measuring it cost initially, you can either decide whether to continue with cost model, or if you want to revalue, you can revalue it. It is true. D. When the ownership of the lease asset is transferred to the lessee, okay, at the end of the lease term, the right of use asset should be depreciated based on the useful life of the asset. True, right? If the ownership is passed to us, the depreciation of the right of use asset will be calculated based on the useful life of it. 44. Complete the following statement as per LK 16 PPE. Depreciation is the systematic allocation of the depreciable amount of an asset over useful life. Now, depreciable amount means cost minus residual value. Okay, residual value. The cost minus residual value is the depreciable amount. That depreciable amount, if you divide by the useful life only, you will find the depreciation of each year. B. The depreciation of an asset should commence when it is, I told in a previous question, when it is available for you. From the date it was there or available, or you were able to use from that day only, you should start your depreciation. The useful life and the blank of an asset should be reviewed at least at the end of each year end. Useful life and residual value. These both are estimates, right? This residual value and useful life, we should at least review at the end of each year. Okay, whether it is changed or not. D. The depreciation expense of a period should be recognized in the P and L. Normally, depreciation expense we have to record in the P and L, right, as an expense, unless it is included in the answer here carrying value. Unless it is included in the carrying value of another asset. What does that mean? Now, well, let's say we are using the machine of our business to produce. We are using the machine of our business to produce a building. Okay. Then the depreciation incurred from the machine will be included to the building cost, right? Yeah. Now that depreciation incurred to the machine can be included in the building cost. Okay. Now we are recording our non-current asset at the carrying amount, right? The PPE or ROU in our SOFP. Okay. Under non-current asset, we are recording it at the carrying amount. Okay. That's what the depreciation, if we are not recording it as an expense, okay, that means what are we doing? What's the next possibility? We might use that machine or something to construct another asset. Then the depreciation included for that asset will be added to the carrying value of that particular asset that we constructed using that particular non-current asset. So that's what here the depreciation expense for a period should be recognized in the P&L unless it is included in the carrying value of another asset. 45. Complete the following statement using the appropriate accounting ratio. High blank ratio indicates that a firm is heavily relying on debt capital. That is high debt ratio. High debt ratio indicates that the firm has more debt capital than equity. B. High blank ratio indicates that a firm is collecting cash efficiently from its trade debtors. High debtor turnover. High debtor turnover ratio. If you have a higher debtor turnover ratio, that means you're collecting money efficiently from your debtors. 3. When the blank ratio of a firm is significantly lower than its blank ratio, it indicates that the firm has to rely on selling inventory to meet its short-term liability. Here, when the quick ratio is relatively lower than the current ratio. Okay, if the quick ratio is very lower than your current ratio, then you should somehow use your, now the difference between quick ratio and current ratio is your inventory, right? Mostly inventory and prepaid expense also. Then for you to settle your current liability, now if you have very less quick asset, what you have to do, you will have to sell your inventory in order to be able to get enough of cash for you to settle your short-term liabilities. Then 46. The following costs are given in relation to an order received by a bakery for a special cake. Further, the bakery had already incurred a sales promotion cost of 120,000 to obtain this cake order. See here, we had a sales promotion cost to obtain the cake order. Now, even if we get the order, we had incurred it already. Even if we don't get the order, we have incurred the sales promotion cost, right? So the sales promotion cost is a sunk cost. Sunk costs are the costs that are already incurred, where whether the order is accepted or not, you cannot recover it. See here, even if they accepted the order, you have already spent the promotion cost. Even if you are not able to accept the order, even if you are not getting an order, you will have to incur that promotion cost. So that's a sunk cost. You cannot recover it. That's a sunk cost. Total relevant cost is because of this order, how much did your, because you accepted or got that order, by how much will your cost increase? Now here, cost of flour, sugar and butter. Uh, Overtime allowance for bakery staff, packaging cost of special cake. Okay, here what are these are the costs that are incurred because of the cake order. So that is relevant for your decision making. You need to say, okay, if I accept this order, I have to incur these and these costs specifically for that cake order. Those are relevant costs. Okay. Then here monthly salary of permanent bakery staff. You already had a bakery staff. You're already paying a salary for them. That is a irrelevant cost. You're already paying them. Okay. You're already paying them. That is not because you got this order. Monthly rent of the bakery. Even if you don't have this bake order, you will be paying your monthly rent, right? Therefore, these are irrelevant costs. So relevant cost total is 550 plus 100 plus 50, that is 700,000. Total irrelevant cost. These two, which you're already paying, even if you order or not, 900 plus the sunk cost. Cost of 120. Sunk cost is also irrelevant for your decision making because it's already incurred. 900 plus 120. Irrelevant cost is 1020. 1020. 47. State whether each of the following statement is true or false. The purchase requisition note is prepared by the purchase department. False. Purchase requisition note is prepared by the stores department requesting the purchasing department to purchase goods. Okay. So it is not prepared by purchasing department. It is prepared by stores department. When the FIFO method is used to value inventory, cost of inventory is higher than WACC method under an inflationary situation. So I'll just tell you all the theory there. At inflationary situation, FIFO method will give you a higher closing stock value and a lower cost of sale value compared to WACC. Compared to the WACC method. So here what they're saying, the FIFO will give you the cost of inventory is higher than WACC under inflationary situation. Cost of inventory means there has been a closing stock, correct? In FIFO method, during inflation, they'll have a higher closing stock compared to WACC. Remember this theory. Then that is true. C, the economic order quantity of an inventory item is the reorder quantity at which the total of its annual holding cost and annual ordering cost is at its minimum. Correct. EOQ is the amount of units at which when you order, your total cost will be at the lowest. Total cost means the total ordering cost and holding cost. That is true. D, the bin card is the record for which the bin card is the record for each item of inventory, showing the receipt, issue, and balance in both quantity and value. False. In bin card, what are you doing? You're just showing how much is the number of units you got issued and how much is balance. So only in units, not in value. Okay, only in quantity, not value. So remember, in bin card, you will show your inventory only in units, the inventory movement in units. In stores ledger, that FIFO method table, stores ledger only you will show in both units and value. Okay, this is false. Bin card only quantity. And 48. Dasun PLC, a manufacturing company. Okay, Dasun PLC, a manufacturing company, and it consists of two cost centers, namely machine and assembly department. Company produces a single product. The information at the activity level of 3,000 units of the company given below. Selling price, net profit ratio, direct material, direct labor. What are they asking? Cost of producing per unit. So direct material 50, direct labor 35. Then your prime cost will be 85. For this, you have to add your production overhead. Okay, production overhead, you have machine department as well as assembly department. Okay, now see here, in the machine department, you're spending 3 hours to produce 1 unit per unit, 3 hours. For 1 unit, 1 hour, the OAR is 25. Then for 1 unit, 3 hours into 25 per hour is 75. Assembly department is spending 2 hours. The OAR is 20. Then the overhead absorbed per unit will be 40. And how much is the production cost per unit? Production cost per unit will be 200. Okay. C, total production cost of the activity level of 30,000. Total production cost at 30. Okay, this shouldn't be asking a question like that because see, this production cost per unit 200. If you multiply by 30,000, you're going to get 200 into 30,000. You're going to get a 6 million. Okay, these are basic mathematics questions. When you're asking it in thousands, you're going to say as 6,000. C. Non-production overhead per unit at activity level of 30,000. How do you find that? Sales minus cost of sale will give you your gross profit. From gross profit, if you minus your non-production from your gross profit, if you deduct your non-production overheads, non-production overhead means your distribution expense, your admin and other and finance expense. So then, when you deduct that non-production overhead from your gross profit, you will get your net profit. Okay. The selling price per unit is 400. Then at 30,000, the total sales will be 400 into 30,000. I write in thousands. 30,000, that is 12 million. Cost of sale. The cost to produce one unit is 20. Okay, sorry, 200. Then the cost to produce 30,000 units will be 6 million. 6 million. Then the gross profit will be 6 million. The net profit ratio is 25%. That means the net profit is 25% of the sale. 25% of 12 million is 3 million. That means your non-production overhead is also 3 million. Now here what are they asking? Be careful. Now you would have gone and written 3 million here. What are they asking? Non-production overhead per unit at the activity level of 30,000. So non-production overhead is 3 million. 3 million. You divide it by 30,000 units, you will get your non-production overhead per unit as rupees 100. Okay, so all these questions are easy though. People are saying that 25 paper was hard. Actually, similar to the standards of all the years. Only thing is it might be a bit more time consuming, but then there are a lot of theory questions in which you can save a lot of time. So if you are taking too much of time to think, there that is where you will waste time and lose your mark. Then 49. The forecasted information relating to a single product manufactured and sold by a company with the production capacity of 25,000 units is given below. Okay, contribution to sales ratio, margin of safety in units and value, total fixed cost. Then selling price per unit. Now here they have given the margin of safety in value and units. If you divide that value by units, you will get the selling price. Selling price equal margin of safety in value 450,000 divided by margin of safety unit. Selling price will be 450 divided by 9,000 rupees 50 per unit. 50. Break-even point. Break-even point will be equal to total fixed cost divided by contribution per unit. Total fixed cost is 120,000. Contribution is 40% of sales. Then 0.4 into 50, that is 20. Then the BEP will be 120,000 divided by 20, that is 6,000 units. BEP in units 6,000. Then profit or loss when the activity level is 15,000 units. So profit equals to total contribution minus total fixed cost. Contribution per unit is 20. Then at 15,000 units, the contribution will be 20 into 15,000, 300,000. Total fixed cost is 120,000. Therefore, your profit will be 180,000. So they are saying to write the profit in thousands, that will be 180. Then last question. A company is considering to purchase a new machine with an expected useful life of 10 years to replace an old machine. The forecasted information in this respect is given below. First, they ask in the initial net cash outflow. Initial net cash outflow. Then you should deduct from the outflows of the year 1, you should deduct year 0, you should deduct any inflows of year 0 and get the net cash outflow. So cost of the machine, 12,000. Residual value you will get at the end of that 10 years. Selling price of the machine 800 minus, that's the inflow, right? selling price of machine, old machine. Selling price of old machine 800, you have to deduct. Selling expense. Then selling expense of the old machine 50, that's the outflow you add. Additional working capital requirement. Working capital requirement 2500. And these two are annual cash flow. Then what will be the net initial cash flow? 12,000 minus 800 plus 50 plus 2,500, that is 13,750. 13,750. Payback period. Payback period equals to initial net cash flow divided by annual cash flow. Initial net cash flow 13,750 divided by annual cash flow. See here, reduction in annual operating cash outflow. Reduction in annual operating outflow. If an outflow is decreasing, you will consider it as an inflow. An increase in annual revenue due to new machine, that is also inflow. Then annual inflow will be, annual net cash inflow will be 2,250. So divide by 2,250. Payback period will be 13,750 divided by 2,250, 6.11 years. 6.11 years. Then total terminal cash flow. So terminal net cash flow means they are asking what is the total cash flow of year 10, the last year. So in the last year, you will get the annual cash flow of 2,250. Apart from that, you will be getting the residual value of the asset, right? At the end of 10 years, you will get the residual value of the asset. The residual value of the asset is 2,000, and also this working capital amount can be recovered at the end of the project. So working capital recovery 2,500. Totally, your terminal cash flow. So normally terminal cash flow means these two, but just when they ask the total terminal net cash inflow, they are asking for the cash flow of year, the last year. So that is 2,250 plus 2,000 plus 2,500, 6,750. Okay, 6,750. So remember, normally terminal cash flow means apart from the annual cash flow, what are the extra cash flows you are incurring in the final year? But here they are asking the total terminal net cash inflow, right? So net cash inflow, that's the total amount you are getting in the final year. That is 6,750,000. So that's all for the 2025 paper.